What do you think?
Okay.
Good to
We'll
go?
continue to have people joining us, I believe, but in the interest of everyone's calendar and knowing that we set a 4:00 start time, I think we should go ahead and get started here. It's about 4:02.
Yeah. So welcome to our first session of our In the BULLpen speaker series. So we've started this, actually, this is our second one. So thanks again for joining. Today it is featuring Jordan Jackson from JP Morgan. Jordan is a global market strategist on the JP Morgan Global Market Insights Strategy team. I'm sure you've seen all of the input that we put out there for JP Morgan. It's in that first kind of market tab a lot of times in our quarterly reviews. And so he's just going to cover kind of over their insights and give us some good introductions into what we see from the 2023 market.
I might add that the JP Morgan guide to the markets is about an 80-page, maybe sometimes a little more than that, Jordan, but many, many pages of market information that comes out quarterly. And we rely on this information greatly in preparing information on behalf of our clients, and we utilize this information regularly. So, Jordan, we're grateful to have your kind participation here and look forward to hearing what you guys think are the highlights of the guide to the markets in the current quarter and the year ahead.
Awesome. Well, thank you for that introduction. Good afternoon, everyone. Very excited to be here. Just on a personal note, I have a 12-week-old at home, baby girl at home, and she slept for 4 hours last night. This is the first time we got 4 hours. So you're going to get the bright-eyed, bushy-tailed Jordan today. But no, very excited to be here. I'm going to start to share my screen. As was mentioned, I'm going to be referencing a few pages from our guide to the markets. And really what we try to do is simplify the complex. Again, this is going to be sort of a truncated set of slides to talk about the big themes that we think are going to impact the market over the course of this year. So we'll talk about growth in the U.S. economy, the outlook for a recession, what a recession could potentially look like here in the U.S. We'll talk about the labor market. That continues to be a bright spot as we think about the broader economy. We'll talk about corporate profits. That'll as we're knee deep in the earnings season, and so we'll get a lot of forward guidance from companies on what they expect to deliver from a earnings perspective over the course of this year. We'll talk about inflation, our outlook for inflation. We'll talk about interest rates, how the Federal Reserve might respond to maybe persistently higher inflation, but also maybe the prospect of a soft or hard landing in the U.S. economy. And then we'll talk a little bit about portfolio construction, how we're thinking about both bond markets, how we're thinking about equity markets, and also how we're thinking about global markets over the course of 2023. So a lot to cover. So let's dive right in. This slide in the presentation, this guide slide 18, looks at real GDP growth. We show real GDP in dollar terms on the left-hand side, and then we show the components of GDP growth on the right-hand side. Now, I think what's interesting, if you look at that table there, you can see sort of the 2022 was really a tale of a year of two halves. And so you had a bit of weakness over the first half of 2022, where you had two negative quarters of GDP growth in the first and second quarter, certainly meeting the definition of a technical recession. But we do not think that actually constitutes a recession once things all shake out. Obviously, as the third quarter was a particularly strong quarter, coming in at north of 3%. And this is important, right? Because if you look at that trend growth rate of around 2%, you can see the economy certainly bounced back. And we're actually anticipating a roughly 2.5% growth rate in the fourth quarter of 2022. So rounding out the second half of last year, pretty strong from a growth standpoint. And one of the reasons why we think growth really ended the year quite strongly is if you look at that big blue block on the right-hand side, that consumption accounts for about 2/3 of overall economic activity. And the consumer continues to really still firing on all cylinders. Consumption growth remains pretty robust. Labor markets, which we'll talk about, are still pretty tight. The unemployment rate sitting at a 53-year low at 3.5%. And consumers have, while they have started to spend down those savings that they accumulated coming out of the pandemic, they continue to fuel that spending, sort of ramping up some credit card debt as well. Now, we may be entering into an environment in which consumers will continue that spending, right? Sort of psychologically, this pent-up demand for services and getting back out there to travel may very well continue to support consumption growth. roughly 70 million Americans are going to be receiving one of the largest Social Security payment adjustments since the early 1980s, roughly 9% increase starting to hit their wallets over the course of this month. And so we do see signs that consumption can be relatively supported over the next couple of quarters. But as we think about the outlook for a recession, it is still, at least in our view, a tough call. And so what are some of the things that we're going to be tracking in determining a recession this year? These are the 6 key variables that the NBER, the National Bureau of Economic Research, follows in determining whether the economy is expanding or whether the economy is contracting. Now, a little bit of history, the NBER has been around since the early 1900s. So they've been the official scorekeepers of the U.S. economy for almost a century now. We think they do their jobs pretty well. But again, these are the 6 indicators that they tend to follow in determining how the economy is performing. You can see real personal income. So that's the income generated. Less government transfers, so excluding all that pandemic stimulus that came through from the government. The labor market by way of the non-farm survey and the household survey. Consumer spending, right? Real consumption growth, as well as institutional spending, and then industrial production. And I think what's interesting, you can see we like to use heat maps. You'll see a few heat maps as we walk through this presentation, but I think it's interesting because it really tells the story over time in a nice visual way. But you can see in March and April of 2020, that pandemic recession, that the deep red there, the deep contraction in all these indicators in the economy. You can see that V-shaped recovery, that bright green, right, coming out of the pandemic recession over the course of 2020. And then as you start to move towards the far right-hand side, as we round out 2022, it's starting to look a little bit more like my front lawn, some tinges of yellow, some beige, and some orange in there. So certainly we're seeing momentum in the economy beginning to slow. And certainly if these indicators dip into red or start to begin to contract, that would certainly be a sign that the economy is in an outright recession. And so we actually track on the bottom half of the page the trailing 6-month change in all of these different these indicators. You can see 5 of the 6 are still positive. So again, we're not in recession, but these are the indicators that we'll be watching for that will tell us that we're in fact in a recession. Now, I think what's interesting is, first, we've never had a recession in which the labor market was strong, where the unemployment rate was falling. 2022, as we round out 2022, it was actually the second strongest year in absolute job growth, only behind 2021. So a very, very strong year in the labor market, a year which is very, very difficult for us to say a recession actually occurred. Here on this chart, we're actually showing the unemployment rate going back over the last 50 years. We try to show as much history as possible. We show the unemployment rate in gray, and then we show wage growth in blue. And we actually like to use the private production and non-supervisory series. In short, it's roughly about 80% of the U.S. workforce, and they account for your typical clock in and clock out worker. So it's much easier and a cleaner measure in terms of measuring wage growth. Now you can see again that unemployment rate sitting at a multi-decade low of 3.5% as of December, and then wage growth, after peaking really in the middle of the year, is finally starting to show signs of cooling off a bit, but it's still quite elevated relative to history. You can see that longer run history of around 4% wage growth, and you've got wage growth that's still running at around 5%. Now, what's really important is right, the Federal Reserve, the central bank of the US, has 2 mandates: stable prices and strong labor markets. And right now, the labor market continues to fire on all cylinders. Where the Fed is particularly worried about is the inflation story. And we'll talk about that in a little bit. But again, they feel like if our labor market mandate is being met by way of strong employment growth, then we really got to focus on our inflation mandate. And that's why they feel very confident that they can continue to lift interest rates in an environment where inflation may be showing signs of coming down, but the labor market continues to perform very, very well. Now, again, we're still in an environment in which you've got this strong excess demand for labor, right? So there's still roughly about 10.5 million job openings. roughly about 6 million people in the economy that are unemployed. And so there's still this big gap between this demand for labor. And so that could very well mean that you get a modest move higher in the unemployment rate in the midst of a recession. We wouldn't necessarily anticipate a double-digit type of unemployment rate in a recession like we saw in the pandemic, as well as coming out of the financial crisis.
Jordan, just anecdotally, all of our clients right now who are business owners, I haven't had a meeting yet where someone said they're overstaffed or they're cutting, but I've had a number of meetings where we're seeking employees. And so I think anecdotally from the Midwest, I struggle to see unemployment rising a lot. I certainly could move, but we don't see it moving upwards a lot. Now, I do see the occasional large technology firms that are laying off 10,000 workers. I think that's the exception, and it might be specific to certain regions or certain industries, but I just don't feel it here in central Indiana unless I'm missing something.
Yeah, I mean, the reality is small and medium-sized businesses are the backbone of the United States labor force. If technology jobs, and I know they get a lot of headlines, a lot of these big technology companies, but technology as a sector only accounts for about 2% of the overall labor force. And so that's why I say small and medium-sized businesses are truly the backbone of the economy. And they're seeing challenges in terms of qualified labor, right? Being able to hire someone with the qualifications and really balancing out, not having to pay an arm and a leg in order to attract that worker and keep that worker. And so there's some real structural challenges in terms of labor supply here in the United States. I think we need a tough look of re-looking at our immigration policy. I think we need to try to, incentivize, bringing prime age working women to come back into the workforce. I think the workforce just is going to look a little bit different as baby boomers begin to retire out and, trying to bring younger qualified workers into the labor force. All of these things, are contributing to some of the structural lack of labor supply and that we're seeing in markets today.
Agreed.
And I will add one thing. If you have questions as we go through this, please put it in the chat room. We are monitoring that and would be happy to ask Jordan questions along the way.
Let's shift gears to talk a little bit about corporate earnings for 2023. This slide, I sort of include this slide here because, when you think about earnings at the top line level, there are three components to it. It's buybacks, it's revenue growth, and it's margins, right? And margins are pretty much a function of companies' efficiency and being able to keep their costs low while being able to generate top line revenue growth. Now, on the left-hand side, we effectively show S&P 500 profit margins going back roughly over the last 30 years. Now, you can see profit margins really peaked out in the end of 2021 and really have been coming down over the balance of 2022. Right now, profit margins are trending at right around 11%. And we're expecting that number to come down slightly as the fourth quarter numbers begin to come through. But I actually think the war on margins is going to intensify over the course of 2023. And the reason being is what we show on the right-hand side. The blue line shows the net percentage of companies that are planning to increase their prices over the next 3 months. The green line shows the net percentage of companies plan to increase compensation over the next 3 months. And then the gray line shows the net percent of companies that expect higher sales. And so you can see that higher sales actually negative. So most companies anticipate a negative revenue growth or sales growth over the short to medium term. And so if you've got slowing revenue growth in an environment where overall economic growth is likely to come down, which we've talked about, where can you kind of try to generate, positive earnings? It's with margins, right? It's trying to keep your costs low while passing those higher costs on to the end consumer. And that's what we're seeing companies are really trying to balance at this stage. You've got higher wage costs. You still have pretty high input costs, although they've come down a bit. And now that you've got the Federal Reserve that's done a significant amount of raising interest rates over the course of 2022, that's going to start to bite in terms of companies servicing the cost of that debt in 2023. So you got all these elements that are sort of threatening companies' bottom line, and they anticipate potentially passing some of those costs on to the end consumer. And I think that's shown really clearly on the chart on the right-hand side. The challenge is right? When you've got revenue growths that are coming down and earnings tend to be hyper cyclical, meaning that they tend to move to a greater degree than what the actual economy is doing. If we're talking about at best a slowing economy, at worst the outright recession, then we do think earnings likely need to come in negative for the balance of 2023. So on the left-hand side of this page, what we're showing are operating earnings for the S&P 500. Now, these are adjusted to the index level. Those blue bars to the right-hand side of that chart show consensus estimates for what earnings will be over the next 3 years. So that first blue bar is 2022's numbers. And as we round out the fourth quarter, that number will begin to firm up. And then those following bars are 2023 and 2024 figures. So right now, consensus is calling for about $225 in operating earnings for 2023. Right. And then if you think about the year over year growth from 2022, that would represent a roughly 12% earnings growth being estimated by analysts for 2023. Now, if I'm an equity analyst, I really do not like the chart on the right-hand side because it basically shows how wrong analysts are leading up to a calendar year of earnings estimates. So I want you to focus your attention to the fifth from the right bar, that 5.5% number on the right-hand chart. What that number is effectively showing is that on average, going back over the last 25 years, analysts tend to overestimate calendar year earnings by about 5.5% at the start of that given year. And so I talked about analysts are currently expecting 12% earnings. Let's just say they meet the historical overestimate. So let's slash 5.5% from that 12. You're right down to a roughly 6 to 7% earnings growth number for this year. So still some revisions that likely are going to need to happen over the next couple of weeks, and that could very well contribute to a bit of market volatility. Now let's also look at the legislative environment. You've got the Inflation Reduction Act. That's going to sort of the revenue generating piece. Remember, 15% tax on profits above $1 billion. And also 1% tax on share buybacks. Now, we think that this is going to impact roughly 15% of S&P 500 market cap and is going to shave off about 3 percentage points of earnings growth. So now we've gone all the way from that 12 down to, let's call it 6. Now you've gone from 6 down to 3. Now, if we're talking about a modest recession hitting the economy, and we think earnings, revenues, as companies expect, are going to be negative over the medium term, then we think earnings really have to come down to -10 to -15% over the course of 2023. So we do think this is going to contribute a bit of volatility to markets over the next couple of weeks. Obviously, markets tend to be a little bit more volatile as companies are reporting on earnings. But we do think once analysts finally begin to firm up some of their numbers for 2023, that's when markets will really be able to kind of find that bottom. We anticipate markets will find that bottom sometime in the first quarter of this year, and then start to look towards a little bit of optimism for 2024 and begin to start to rally, always typically ahead of when the economy actually begins to start to roll over. Now, let's talk a little bit about inflation. Now, again, this is another heat map, but I think this does a good job in really telling what are the components that have been contributing to the inflationary pressures that we've seen really over the last 2 years. Now, we've sort of bucketed inflation in 4 categories on this page. You've got energy inflation towards the top. You've got food and core goods towards the middle of the page. And then at the bottom, you have core services. Now, what was the buzzword in the first half of 2021? It was supply chains, right? And that was really putting pressure on core goods, things like apparel, things like vehicles, new and used vehicle prices. And so if you look at kind of the first half of 2021 to the left-hand side of the page, you can see that red there, right? That red across core goods, that hot inflation. And that was really contributing to the inflation that we saw over the first half of 2021. Then as we move through 2021 and into 2022, of course, you had Russia's invasion of Ukraine, and that really impacting energy prices, energy inflation, as well as food inflation as well. And so you can see sort of those red tinges across energy as well as food inflation over the first half of 2022. Now, what's contributing to inflation today, if you look at the bottom of the page, it's core services. And in particular, it's things like shelter, rental inflation, and owner's equivalent rent. And you can see that those red numbers there down at the bottom continuing to run very, very hot. And that's really been contributing while headline inflation has been coming down. That's really helping to contribute kind of the firmness that we're seeing on the core inflation side. And as we highlight, you've got headline inflation as of the end of the year running at around 6.4% year over year, and then core inflation running at about 5.7% year over year. Certainly down from the peak inflation that we saw really in June of this year on the headline level, and really in September on the core level. We anticipate inflation will moderate over the course of 2023 to a roughly 3.5% level, and then before moderating to a 2% level over the course of 2024. But remember those two mandates that the Fed talked about, that I talked about the Fed has. It's inflation as well as labor markets. And the labor markets are firing on all cylinders, but for stable prices, the Fed wants 2% inflation. And I talked about inflation getting to 3.5% by the end of 2023. So it's unlikely inflation is going to come down as quickly as policymakers would like. And this certainly runs the risk of the Fed doing a little bit too much in terms of increasing rates and thereby further exacerbating what could be a recession, a modest recession, into a potentially deeper recession. Now, what is the Fed calling for? What do they anticipate that they're going to do over the course of this year? And this is a great slide that really talks to that. This is looking at the federal funds rate. This is the Fed's primary tool in how they adjust monetary policy. We show that historical Fed funds rate in gray. And then I think what's more informative, if you look at the far right-hand side of the page, the blue diamonds, the dark blue diamonds show where the Fed anticipates federal funds rate will be, that interest rate policy tool will be over the next 3 years. And then the green lines are currently what the markets are pricing in. Now, you can see there's a pretty big divergence in terms of the first couple of dots there. The Fed is going to anticipate getting to 5%, roughly a little bit above 5% on the Fed funds rate, and keeping that there for the duration of 2023. Now, this is, again, these are year-end contracts. These are figures as of December of each year. But the markets are saying no dice, right? The market isn't buying what the Fed is selling. The market is saying, yeah, the Fed will get up to maybe 5% by their May meeting, but then they're going to have to make a roundabout and have to start cutting rates. Effectively, the market is anticipating a recession, maybe anticipating a deeper recession, and for the Fed to have to make a complete roundabout and have to start cutting rates over the back half of 2023. Now, the challenge is when you have this disconnect between what the Fed is saying versus what the markets are currently pricing in, that might suggest that interest rate volatility, or the movement that we see in things like 10-year rates or things that we see in 2-year rates, could be quite volatile, right? As the market tries to either further agree with the Fed or maybe push the Fed more in line with what the markets are pricing in. So again, similar to equity market volatility on the back of earnings, likely is going to be a bit high over the first quarter of this year. We think bond market volatility may be a bit high as well, just given the uncertainty around the trajectory of monetary policy over the next couple of quarters. Now, let's talk a little about portfolio construction. This is a good chart because it really highlights just how difficult a year as investors 2022 actually was. This chart looks at the annual returns on a 60-40 portfolio going back over the last 72 years. We actually take this back all the way to 1950. Now, the green bars are the equity component on that 60-40 portfolio, the equity return, and then the gray bars are the bond return, the fixed income return on that 60-40 portfolio. If you look at that 2022, a 60-40 portfolio was down 16% last year. You have to go back to 2008 to get a year that bad on a 60-40 portfolio. Then you've actually got to go all the way back to 1974 to go back to a year in which both stocks and bonds were negative in the same year, right? We know bonds are supposed to be that ballast to the portfolio, that zig to the equity market zag, but everything zagged last year and nothing was zigging. And that was really the challenge for investors in 2022. But you're already starting to see a pretty sizable reversal in that 60-40 so far year to date. The beauty of the guide, we actually update this on a daily basis, So as of the end of last week, Friday's close at 60-40 portfolio is up close to about 4.5% so far in the year. And you've got positive returns coming both from equities as well as bonds to kick the year off. And so you're already seeing a little bit of that reversal. And a big reason for that was you just had a massive reset in valuations, right? The price paid for an asset on both the stock and the bond side of the equation. Now, this chart here just looks at that valuation component across a variety of different bonds as well as stocks. And we show sort of the asset classes on the x-axis toward the bottom of the page. Those blue diamonds show where those valuations were at the end of 2021. And those brown circles, dark green circles, show where those valuations are currently trading. A couple of things that I want to focus on. First, look at the spread or the gap, right? This is the valuation reset that has happened both across treasuries, core bonds, as well as large cap and growth stocks. You're looking at roughly 2 standard deviation moves in bond and equity valuations over the course of 2021. Now, in terms of absolute valuations, right? Bonds look outright cheap, while stocks, still look a little bit expensive, particularly growth stocks, which we know have sold off a lot over the course of 2022. Maybe they've got a little bit more weakness ahead of them, providing an interesting and attractive entry point for longer-term investors. But I would go as far to say that, we could very well be in a year, 2023, could be a year in which bonds perform better than stocks. We are anticipating a roughly 5% or mid-single digit return year coming from stocks, but we could very well see a year in which bonds perform high single digits, low double digits over the course of 2023. And again, this is just looking at valuations. Bonds, generally speaking, look outright cheap, while stocks still look a little bit expensive, but we can appreciate the big reset that we've seen in valuations across the board. Now, this is a slide that's a gentle reminder that we should, as investors, have a longer-term approach when investing in risk assets. Because the reality is it's not a question of if, it's a question of when markets reach their previous peak. And markets always reach that peak and subsequently move past that peak. But that last peak on the market was January 3rd, 2022, a little bit over a year ago today. And at the index level set at 47.97 on the S&P 500. Now, as of the close of Friday, the index sat at 3,999. And so the bars there show what your return would look like under different time horizons to get back to 47.97 on the index. So I know we talked about, the possibility of a recession over the course of this year. Let's just take 3 years, all the way out to January 17th, 2026. Now, if it takes 3 years for the market to get back to 47.97, you're looking at an annualized return over the next 3 years of around 8% on the market, roughly 26% cumulative return with dividends reinvested. That's a pretty attractive trade-off, right? If I'm a long-term investor, being able to get 8%, we may be underappreciating that number because we know markets are forward-looking and may actually start to recover well before the economy begins to roll over. So even if you're looking at 2 years getting back to 47.97, a very impressive 11% annualized return over the next 2 years. So again, I think it's just really important to have a longer-term perspective, recognizing that, as we just talked about, valuations have improved pretty significantly across the board. And maybe now's the time to be dollar cost averaging into the market, beginning to start to shift the portfolio with a little bit of risk in there, taking advantage of cheaper valuations, knowing that you may very well be holding these assets, these equities for the next 3 to 5 years, and can benefit from strong market returns. Now, valuations have also improved, as we've talked about, on the bond side of things. This chart looks at the gray bars show the 10-year range, or the spread between the max and the min, that yields have been for a variety of different bond sectors. So you have your more investment grade bond markets on the left-hand axis. You've got your more extended sectors like high yield and leveraged loans on the right-hand axis. Now, those blue bars show where yields are currently trading in these different fixed income asset classes. You can see that they're above the 10-year median, and they're pretty much near their 10-year peaks, their 10-year max. some of the most attractive yields that you're able to get in bonds that we've seen really in over the last decade. And again, this is just a function of the aggressive amount of rate increases that the Federal Reserve has delivered over the course of 2022. Being able to get 5.5%, 6% on a municipal bond on a tax equivalent yield basis looks pretty attractive to us. Being able to get 5% in a high quality corporate bond, AA, single A rated corporate bond, strong balance sheet also looks pretty attractive to us. We talked about consumers in a pretty healthy position. So high quality consumers that auto loans and personal credit card loans that are backed, backed again by strong consumers, ABS, asset-backed securities, look pretty attractive to us. You're able to get 5% depending on where you shop there. So there's just a variety of opportunity, that we're seeing within the fixed income side of things. And again, Jordan, as I highlighted, I wouldn't be surprised to see bonds performing better than stocks this year.
Hey, Jordan, I'd be curious to see this chart. The last 10-year period, we largely had interest rates at 2%. It was an unusual period of time for rates. I suppose if we did this same chart on rolling 10-year periods going back into the 70s and the 80s, it would look wildly different. So I'm curious why you choose 10 years specifically for that comparison time.
Sure. Well, if we were to take this chart back a little bit further, to your point, it may look a little bit different, may not look as attractive. But we're rounding out or may have concluded a 35-year bull run in bonds, which yields really peaked out in the early 1980s. The Fed funds rate peaked out at around 15%, and really bond yields have been steadily coming down over the last 35 years. And to your point, they really troughed. The Fed had rates at zero for much of the last decade. And now things might be certainly last year was a stepping out of that bond market bull run with negative, double-digit negative returns coming out of bonds. But again, this big valuation reset relative to recent history looks pretty attractive.
Good.
Now, I wanted to include this chart because, again, this kind of puts a little bit of history in context in terms of bonds and really highlights the simplicity almost of bond math, right? The starting yield that you buy a bond is a pretty good indicator of what your returns are going to look like over the next 5 to 7 years. So this chart just looks at the historical relationship between the starting yield on the Barclays Agg or the Bloomberg Agg and the subsequent 5-year total returns coming out of the Agg. And so it's a pretty tight relationship. But what you can effectively see as at the end of last year, you were able to get roughly 4.68% of yield, that you were buying the yield on the Barclays Agg, the Bloomberg Agg. I'm so used to saying Barclays Agg, the Bloomberg Agg. That would suggest the historical relationship were to hold, you're looking at a roughly 5% annualized return over the next 5 years if you would have bought the Barclays Agg at the beginning of this year, right? So again, this is a much different environment. If you were to go back just a couple of years where rates were at zero, you were buying the Agg at say 175 and maybe locking in an annualized return over the next 5 years of just shy of 2%. Now that number has improved to, as we highlight, a roughly 5% level. So again, a much more attractive sort of trade-off as we think about the return prospects coming out of bonds, given yields are significantly higher than where they've been over the last decade. Now, I want to save some time for some more questions. So we're going to walk through international relatively quickly, and then we'll open things up for questions a bit. But here's another heat map. What we're showing here are purchasing managers indices, or PMIs, for a host of different global economies. We have your developed market economies towards the middle of the page. Then we have your emerging market economies towards the bottom of the page. And again, we like heat maps because I think it provides a good visual. Keep in mind when you think about PMIs, that key level of 50, so level above 50 signifies expansion in an economy, a level below 50 signals a contraction. And then we've color coded this heat map based off of that key level of 50. But you can see to the far left-hand side, right, the global financial crisis, that deep red, right, really bringing the global economy under pressure. As you move towards the right, 2011, 2012, You can see the Eurozone debt crisis really putting pressure under European economies, think France, Italy, and Spain. You continue to move towards the right. Now we're at the middle of the page, 2015, 2016. The commodity collapse that we experienced really impacting some emerging market economies, particularly commodity exporters like Brazil and Russia. And then to the right-hand side, you can see the pandemic, right? The global pandemic, that sea of red impacting the global economies. Now, as we look towards the far right-hand side, as we round out 2022, it's quite clear to us that the global economy is coming under some meaningful pressure, right? You've got China that is dealing with another sort of surge in COVID cases as they pretty much abandon their zero COVID tolerance policy. And so consumer confidence remains very challenged. They're dealing with the unwinding of an overly leveraged property sector. And so we do think it's just going to take a little bit of time for China, a couple of quarters for China to get back online. Europe, while they may be narrowly averting a recession, they're still dealing with the hangover from an energy crisis. And so we are expecting a bit of weakness out of the European economy as well over the next couple of quarters. Generally speaking, the U.S. Continues to be sort of the best house on a really tough block. And so we have a preference for U.S. in a global asset, a global portfolio. But that said, we do think that there are some interesting opportunities beginning to bubble up for international. So the left-hand side of this page just looks at the valuation discount that you're able to get by owning international stocks versus shopping here in the U.S. So the way to read this chart is, on average, international stocks trade at about a 14% discount relative to the U.S. Well, they're now trading at a close to 30% discount relative to the U.S. If you look at the right-hand side, we're having more and more conversations about using equities as a source of income. You're actually able to get roughly 1.5 percentage points more in dividend income by owning international than you are here in the U.S. The last point that I would make about making the case for international is the value of the dollar. Now, as a U.S.-based investor owning international markets, a falling dollar acts as a nice cherry on top to returns, helping to boost returns as a U.S.-based investor. Now, over the course of the start of the year, we've actually seen the dollar begin to weaken a little bit, which has been a welcome after the dollar really appreciated significantly over the course of 2022. But what's really interesting is that the dollar tends to behave in these very long-term regimes, right? You tend to get 5 to 7 years of dollar appreciation, followed by 5 to 7 years of dollar depreciation. Well, we've just been in an environment where the dollar has actually been appreciating for roughly the last 7 years or so. And we think we are in the early innings of dollar depreciation. And that's going to act as a pretty good, again, as I mentioned, cherry on top to returns as a US-based investor going international. Now, again, I think the dollar is going to remain somewhat strong over, say, the first quarter of this year. The reality is, as I mentioned, the US continues to be the safest house on a pretty tough block, if you will. And also the Fed is still hiking interest rates. But we will be in an environment in which, say, the baton gets past the international growth. So global growth begins to start outpacing the US as Europe and China come back online in the second half of 2023, at a time where the US economy may actually be slowing down, right, as we've talked about. And also the ECB and the BOE, and now maybe even the Bank of Japan, actually may still be tightening policy where the Fed may actually be reversing course. All of that suggesting that the dollar may actually have some scope to weaken from here over the course of 2023. Last point that I want to make, we call this our jelly bean chart. I'm more of a Skittles guy, so we'll call this the Skittles page. But each of these boxes represent a return in a given asset class going back over the last 15 years. Now, what we've done is we've created a globally diversified portfolio using each one of these, using a percentage weight of each one of these individual asset classes. And that's that asset allocation portfolio, that light gray shaded boxes that track the black line on the page. Now, the point that I want to make here is that globally diversified portfolio is never at the top of the page. It's never at the bottom of the page. It's always hovering right around the middle. And that's really the point of diversification, right? We don't diversify because we think we can cobble together the best performing assets in a given calendar year. We diversify so that when one part of the portfolio zigs, the other part of the portfolio zags. And that helps to minimize volatility. That helps to smooth out the ride for investors over time. Now, as I mentioned, 2022 was certainly a challenging year, particularly a year in which cash and commodities were the only two asset classes that had a positive return year in 2022. Not enough of the portfolio was zigging or zagging to help diversify just last year. But over time, diversification benefits have really proven to, again, smooth out the ride for investors. And if you look at those columns, those two columns to the far right-hand side of the page, the furthest column is volatility. Then the second from the right is that annualized return. One of the things that we as investment professionals, we like to look at the what we would call Sharpe ratio or risk-adjusted returns. How much risk are we taking on to generate positive returns within a portfolio? And if you actually were to look at all these different individual asset classes relative to that globally diversified portfolio, that globally diversified portfolio has the best risk-adjusted returns than any individual asset class. And I think that over time, that really just shows the benefits of broader diversification within a portfolio. So with that, let me pause and see if we can open things up for questions. I think I have access to the chat box as well. So if you want to go ahead and type your questions in there, we can get those answered.
So I have to say, first off, Jordan, I did not know that this was updated daily. Your team is absolutely amazing that they can get this presentation updated that quickly. It just shows all of the work that you put into this. And that's really why it's always relevant information, which is wonderful. The thing that, as I hear you and the other people that we rely on for information is, what the next 5 years looks like is going to be different than the previous 5, right? Anyone that's listened to Chris Cooke for the last 5 years has heard how much he dislikes fixed income because of the space that we were in.
But I'm changing slowly.
But to your point, there's a lot of opportunity in spaces, whether it's fixed income, international, private markets, whatever that be, that may have some opportunities in the next 5 years that we haven't seen it in the last 5 years. So.
No, that's absolutely right. One of our mantras for this year is bonds are back. So again, after a very, very tough year, that's typically when you want to begin to start taking opportunities.
I'd like to have any of the clients that are on the line, feel free to type in a question in the chat box. I'd also like to make it a point that these slides will be sent out to everyone at a later date, probably later today or tomorrow. And many of you are familiar with these slides because the Cooke Financial Group cherry picks a lot of the same slides you chose, Jordan, and we use those in our quarterly meetings. So we thank you for highlighting those. Are there any questions from the audience? I don't see any at this time. Jordan, we're on about 45 minutes. Is there any other last thoughts? Your team, Dr. Kelly, David Leibowitz, yourself, and many others. How many are on your team total to try and pull together this information?
Yeah, well, our team is global, and we have about 30 folks on our team globally. Here in the U.S., we have a team of 8, 5 strategists, one being myself, and then we have 3 analysts that support our efforts.
We do have one question from our audience asking, what's the best way to pull out an RMD? And I actually think I call this chart the quilt that's on the screen right now. I think a quilt helps to answer that. When we have a diversified portfolio and one piece of that diversified portfolio gets too large, maybe it has outperformed, frequently that is a great piece to pull from with my distributions. If you think about adjusting a portfolio, there are always 3 methods to make adjustments. 1, I add new money to the item that's light. 2, I take away money, distribution, from the item that's too heavy. Or 3, I go back and forth between different items, between the colors on this chart, for example. So if I'm looking for a required minimum distribution from an IRA, my first step is to look at the broad portfolio and see where I'm overweight, and then to pull at least the predominant amount of that distribution from those overweight sectors. But we want to maintain our diversification even as we draw down an IRA. I hope that answers the question.
Well, I guess with that, I think we will wrap it up here. Jordan, thank you for your time. Congrats on the little one.
Yes.
We would have no idea. That's very exciting. So thank you for all your time. Thank your team from us. And thank you to everyone that could join us today. Hopefully we'll have our third series out here sooner than later.
And Jordan, we're little person friendly. So next time if you want to have your wife bring the baby in for a quick viewing on Zoom, we like that.
All right.
Dogs too. We like dogs or babies, all of it.
We'll take it.
Well, we'll consider the dog once we get a full night of sleep. All
right.
Right at this point.
All right. Well, thank you, everyone. Have a wonderful day.